Welcome to the Smart Property Investment Show, the podcast by investors for investors.
Good day, how you going? Phil Tarrant here. I'm the host of the Smart Property Investment Show. And right this second, trying to log into my computer because I have some data that's landed in my inbox that I wanted to share with you today. To give a sense for the direction of property markets in Australia. And as we speak, I'm trying to get onto our company Wi-Fi, which is proudly led by our good friend, Mike too. He loves data. He loves Wi-Fi, and that's the connectivity we need because it's in my email. What it is, it's a breakdown, and you would have seen it. We launched the Fast 50 report earlier this year. This is a body of work that was underway for a couple of months before we got the report out, which most of you would have downloaded at some point over the last sort of 6 or 7 months. The Fast 50, where to put your money today for the best capital growth in 2024. We're partway through it. We come to the end of 2024, and as a body of work, it curated a whole bunch of views and opinions, sentiments, research, data input from a range of different stakeholders inside of the property sector in Australia, from buyers agents and data researchers to heads of franchise groups and big real estate organisations. And what we did, we glued it all together and we come out with the best suburbs for capital growth in 2024. I'm having a report with been pretty good. So what I wanted to do is we near the end of the year, I'd really wanted to recap on how it's all gone. And before we do that, the good news is that there will be a report next year as well, which we're working on right now. We have our boffins, our nerds, our data people are all working through it as we speak, trying to work out, and we can let you know early in the new year where to put your money today or in January, February for the best capital growth in 2025. And that's what this report is all about. But we're going to pull it apart to see how we're tracking for the 2024 installment of the Fast 50. Joining me back in the studio, Paul Glossop, who helped unveil this report about 7-8 months ago. He's our partner in working on putting this together. He was a big contributor in a lot of the suburbs that he and his organisation, Pure Property Investment, recommended. And I'm going to see how, in particular, he's gone. Paul, how you going?
I'm very well, mate. It might be a good opportunity for me and my team today to do a bit of crowing, I'm hoping, as we look through some of these contributed suburbs and get the chance to. I mean, it's a little bit risky as a property investment advisor and buyer's agent to put essentially numbers and suburbs to the test at the start of a year and then say, look, we'll review it and we'll see how we've gone versus the national averages. But we're going to unveil essentially how our contributions to this Fast 50 report have performed, and also probably get a bit of a theme as to which markets and which property types we really thought would do better than the national average.
Well, a theme, yes, because just looking at the data here, and there's a certain theme which dominates the suburbs that you chose. And for those of you who, and I've got the spreadsheet here, and hello to everyone sort of tuning in on the YouTube and some other streaming platforms. We asked a whole bunch of people to tell us where they thought which suburbs, which areas gave the best chance for capital growth over the coming year, so in 2024. So we always do this report thinking a year ahead. So when we announced and unveiled this report, it was where to put your money in 2024 for the best capital growth. So looking
for 2024.
Yep. For where to put your money to have the best propensity or chance for capital growth. So when we do this report again in a couple of months' time, it'll be where to put your money for 2025.
Yeah, for
capital growth. And universally, the report has fared pretty well. But considering you're in the studio and we originally worked with you on this, and I'm happy to report that Pure Property Investment will again be working with us on the next report. So you'll hear more from me and Paul as we unveil the next instalment of this. But why should you rely on this report? Why should it matter? Well, I think based on some of the indications, some of the suburbs that you put out, Paul, the numbers are right.
They
Largely?
I'm going to say entirely, if I'm honest. But I guess to give the listeners maybe anyone who hasn't downloaded a report, it's still available, I believe, on your website.
Yeah,
Phil,
absolutely.
Isn't it?
I just re-downloaded it myself before coming on air. If you just go to smartpropertyinvestment.com.au, you'll see it right at the top. You can download it. It's pretty easy. Just put some details in. It arrives in your inbox. So
absolutely.
I just did it, and it worked really, really easily.
Good. And I think the reason why maybe not so much looking at the data of this report now, because it's the data that was inserted in there, not just from my team at Pure Property Investment, but by all the other contributors, was probably early 2023 when this data was put in there. So it's not a bad time for anyone who's sort of wondering about the validity of this and this report and the contributors to figure out, where did people recommend to put the money and where have those markets, well, how have those markets performed over not only this 12 months, but obviously we're intending to say, look, we don't in turn suggest that probably should be invested in for a 12-month outcome. However, it's quite an interesting exercise in essentially the methodology and how it works. But the breakdown of the states, and anyone who follows smartpropertyinvestment.com or our website at Pure Property Investment, they will probably no doubt see very regularly. There's a lot of data put out there about national averages, state averages, city averages, and how markets are performing. But the contributors of the states was in Queensland, there was 18 suburbs in Queensland. Western Australia, there was 15 suburbs that were recommended in Western Australia. South Australia, 10. New South Wales, 4. Victoria, 2. Tasmania, 1. No one mentioned markets, or no markets rather, in the Northern Territory made the cut. And if we look at the CoreLogic data that was just released only literally last week, and looking at the performance across Australia over the 2023 timeframe, Perth has been a standout as far as capital growth versus any other major city. That was closely followed by both Brisbane and Adelaide, and then also Sydney. So if you look at the conglomerate, and that excludes obviously yield, but if you look at those averages, they feature in the three most featured states as well as cities that are in this report. And we'll dig deeper into those specific suburbs and how some of those suburbs outperformed even the citywide averages as well.
Yeah, and those numbers, and I looked at them last week when they came out from CoreLogic, sort of just affirmed what I thought anyway. We haven't missed it with this report. And when you think of some of the people who also participated in this report, and we asked everyone on the panel, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14? 14 people, including Paul. The logic was, you tell us based on your analysis, your interpretation, everyone's got a different way of doing it, the suburbs you think are going to show the best capital growth in over the next 12 months. And I'd score everyone pretty well across the board on this, and indicative. And some of the people, for example, you've got big real estate group chiefs like John McGrath, who's the CEO and executive director of McGrath, Angus Rain, who's the executive chairman of Rain and Horn. You've got
Kevin Brogan, Heron Todd White.
Yes, absolutely. Nicola McDougall, who's the chair of the Property Investment Professionals of Australia. People like Margaret Lomas, synonymous with Real Estate Australia for many years. You've got Lena Lindley there, who's one of your team members.
Senior buyers agents at Pure Property, for sure.
Absolutely. The chief economist from PRD Real Estate. There's a lot of people here who have all served up their own suburbs and reasons for, but with the objective of capital growth. This is not the cash flow or a yield thing. It's a capital growth thing.
Correct.
And getting that 50 together. Go back, and myself and Paul spoke at length around it all, and we gave a lot of insights. We did, the best in certain areas and the best, regional versus metropolitan. We did a sort of close but no cigar type groups, the best of the rest, and that was really good. So lots of insights. We don't need to go back over it, but Paul, let's give some sense for the performance of the areas that you chose. And I have a huge news flash for everyone. They're all in the one state. You can probably work out what and where that is, but we're going to get stuck in it. We'll just go to a break beforehand. Stay with us, everyone. Back in a moment. Welcome back, Phil Tarrant from Smart Property Investment Show with Paul Glossop, and we're chatting through the performance, a bit of an update as we sort of round out the end of this year and we start looking at releasing next year's Fast 50 report. Paul, from your side of things, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13 locations that you predicted made the report. And again, you can go back and tune in around the methodology to come up with this list. It's pretty detailed and pretty robust considering how we've done it. And then when you contemplate the fact that even for someone to suggest a suburb means it's gone through even more research and more insights and analysis. So a lot of work's gone into a lot of these suburbs and the assessment of these suburbs. Paul, I'm looking at a list here and you're giving me a year-to-date actual growth for 23. So I note that you probably provided these suburbs in March of 2023 for the report, which we handed down a month or so later. Only one suburb is in single-digit growth, 9.80%. So you nearly got all of them in double-digit growth. What was the CoreLogic data on Western Australia or Perth that came out last week in relation to average annualised growth?
I think average annualised growth, excluding rents and combined rents and capital growth, was I think it was in the circa 11 to 12% annualised for Perth, excluding regional. There were some markets which probably contributed to far, far higher percentages when you look at some of the regional markets that are very, very small towns. And when they see higher sales, it throws out their data a little bit. So there's a few anomalies, I believe, in the data there. But it was circa 11 or 12%, coupled with yield. It was more like 16, 17, 18%, depending on where you looked.
So the suburbs that you chose that actually made it into the list, and we'll go into them, the bottom of the growth, 9.8%, and the top year-to-date annualised growth, 19.4%. So that's not bad going over a period of time, is it?
Yeah, and remembering this data that we're looking at here, this isn't necessarily 12-month data. This is about 9 months worth of data. So this is effectively, we launched this, or the data was contributed in March, April 2023, and we're obviously looking back in review of that time between then and now and how that performance has been since released. So ultimately, what I guess there's probably a couple of big things, and anyone who wants to actually get access to the list that we've contributed to, I'm more than happy to send this through. So if people want to reach out to me, they can email me at inquiry@purepropertyinvestment.com. Happy to send them through that list.
Inquiry or inquiry?
ENQUIRY at purepropertyinvestment.com. I can send them our revised list.
Well, you're going to send them the list that I'm looking at right now.
Correct. I'm happy for them to send them through, and they can look at that specific data if they want to have a bit of a squiz through that there. But I guess one thing that is very obvious, and when it comes down to our contribution to this list, initially, none of our recommendations were regional, and whether it's regional WA, whether it's regional Queensland, and people have different...
You just hate people from the regions, though, is it?
Yeah, absolutely. I'm a hater, massive hater of the farmers and the livestock.
You hate Australia.
It's un-Australian. But I guess one big thing that was becoming very obvious at the start of the year, which has definitely played out through this year, is the factor of immigration, overseas migration has put a lot more pressure on the major cities and where those jobs have come. And that data that came out from CoreLogic only as of last week, Phil, you probably would have seen it, that there's been a big shift. Regional markets certainly took a bit more of the mantle for growth back in 2021, 2022, peak times of COVID, and a lot of tree change was going on then. There's a bit of that now morphing back to the major cities, coupled with that migration, and the regions have underperformed dramatically compared to major capital cities when you look at the growth for this year and how that's contributed to this data. And I think that's going to be a theme that will likely play out very significantly over the next couple of years, and you'll probably see that feature in the next report that does come out. There'll be probably a little bit less in that regional market, a little bit more in the major cities. And ultimately, all of our contributions were major capital city, or at least sort of, a maximum of circa an hour to any major capital city, and making sure that those employment hubs are really where those markets are going to be driven by more people, more demand, less supply. And that's the thing that's playing out right now.
Yeah, and this report and the next iteration of this report, which we're working on right now, getting ready for release early next year, which will be Where to Put Your Money Today for the best capital growth in 2025. I think a major theme around people's assessment will be the impact or implications of migration. I was only reading the paper today. There's a lot of angry people out there around immigration at the moment. I can't remember. Dick Smith. I read a piece from Dick Smith this morning who was pretty much saying it's quite hard for him. I get he's going, Australia's been good to me and I've made a lot of money, but, you know, he was talking about he bought his first property in Greenwich, which was a waterfront for $70,000 or something. Said it was cheap, right? And his deposit was cheap, and he's going, you know, real estate should be 6 times people's salaries when it's up there, if like the mortgage connected with it 12 and 13 times. And he was pretty much saying the government's failing Australia by migration, right? Well, I don't want to get into the politics and Dixby's a great Australian, and he can have his opinions. Absolutely, that's what makes this nation a great one to live in. But what does that mean for real estate? Well, I think a lot of the trends you see for capital growth in the next report will be where are the immigrants going?
Yeah.
And a lot of it's going to be connected with growth, and whether or not they're going to be able to attract new Australians or new to Australia residents out to the regions. I'm not too sure, but you're certainly going to get it in those sort of rental belts around the capital cities, and by that I'm thinking, I can't see too many migrants sort of moving into inner city Sydney or maybe Alexandria. They're going to be out west, out southwest, out northwest.
Yep.
And you're going to get a very similar trend in other capital cities. Whether or not that's going to extend out to Perth, what's the percentage of migrant community moving out into Perth?
Look, it's pretty close to in line with where both Sydney and Melbourne are tracking. Okay. So not that obviously it's at the same numbers or the same ratio, because the vast majority of migrants, when they do land, international migrants are landing in Sydney, and then Melbourne a little bit towards those two details. But when it comes down to where they go from there, and then the data probably more specifically as far as not necessarily how many are moving to, whether it's Perth, whether it's Brisbane, whether it's Sydney, whether it's Melbourne, I think one of the biggest stark realities, and this data has been pretty consistent since we've opened our borders from migration over the decades, it takes typically a minimum 2 years for someone who lands in Australia who's going to be in the vicinity of finding accommodation, finding a job. Most of them are skilled migrants, so they're going to be finding a job in the professional space because they're typically coming over on a skilled migrant visa or somewhere, or a student visa. And then from there, what we find is it's that 2 year time frame before they actually figure out where they want to be. Now, that's not necessarily where they want to buy a home, but where they want to probably more permanently be based in that country or in that city or in that state, whatever it looks like. And then from there, obviously, that's when they put down roots, whether it's buy homes, start families, start businesses, whatever it looks like. But there's that 2 year sort of window where people might land in Sydney, think, okay, actually, I'm going to move up to Brisbane because there's more work there. It's a little bit more affordable, and I can potentially do the same thing. Then they might bounce to somewhere else, so on and so forth. But that's the big thing to remember, that there's quite a transient nature of the migrants who do come.
Yeah, and that would be considered interstate migration.
Exactly.
Because they come here and they come out to Sydney or Melbourne and just sort their stuff out over a couple of years and then get ready for choosing where they want to live long term. To your point also, families moving out here might not be choosing those inner city locations, but I tell you who is, the university students. And
correct.
Which again, it's temporary migration in many ways, but I don't meet many university students who, if they get a chance to stay in Australia, won't stay in Australia.
Exactly.
I reckon if you ask 99% of university students whether or not they'd like a visa, they say absolutely yes, please. And again, this is going to be a big engine for fueling migration moving forward, and it's for the government to determine what's enough and what's right and what's required and what's needed, balancing all those sometimes sensitive issues when it comes to migration. Thinking back on the Dick Smith article I sort of read earlier today, he was talking about sort of the migrant inflows back in the 90s was tiny comparatively to where it is today.
Yeah.
We're certainly on the accelerator pathway, and, it's good to keep fueling. He's talking about a population in Australia by the end of the decade of 100 million.
Yeah.
Oh, sorry, the end of the century. Of 100 million.
There was some of those trends showing,
crazy.
But I mean, that's obviously put on the premise that we continue on this circa 500,000 people per annum, and that sort of grows in line with where our actual overall population is. But it does beg the question that we're certainly not we have a select number of cities which are very big. Yeah, even globally, comparatively, our cities are big cities.
Oh, they're massive.
They're massive.
If you put Sydney or Melbourne into the US, I think they're probably the 4th and 5th biggest city.
Exactly. They're top 10 types of cities.
After Chicago and New York and probably LA's
probably potentially not. San Fran.
San Fran's tiny.
Yeah.
San Fran's like 1 million people, right?
Yeah, exactly.
It's like places like Fort Worth or Dallas is pretty
Correct.
big. But they're big, big cities.
They
they're
are.
proper cities that we live in here.
Yeah, and even when you start to think, Brisbane's north of 2.5 million, Perth's going to be 2.5 million within the next few years. You've got big cities that sit out there. These are our 4 big cities, and ultimately, when it comes down to, I guess, back to the point you bring up with Dick Smith here, is that if this population growth continues, it's all good and well for us to say, well, let's give them more incentive to move out to the regions. But and this goes back to this issue we've got right now, and the reason why we've seen in a lot of the markets that we've predicted or forecasted, we've seen in excess of 10, 12, 14, 15, 19% capital growth. You can't, there's 2 big things that are always the impediment to when you see a lot of extra demand come out. And you can create demand a lot quicker than you can create supply. And that's the challenge right now, is that demand can come by migration, whether it's interstate or overseas. And that's happening in spades across the board at the moment. We are running towards record low supply levels, particularly for freestanding houses. Units are still trending well below long-term averages. And if we keep going along these ratios, we've got rents growing at the fastest level on record, basically, and we've got supply trending towards its lowest levels on record, coupled with the highest level of migration. Yes, we have very, very high interest rates comparatively to where they were over the last 5-year averages, but long term, they're probably pretty close to the last 20 years worth of averages there. We're probably pretty close also to the top of this interest rate cycle. So I guess what I'm trying to paint a picture on here is anyone who's thinking about sitting on the sidelines or potentially investing for 2024, 2025, if we're close or are already at the top of this interest rate cycle and the next move is down, regardless whether it's in 6 months, 12 months, 18 months, the ecosystem for a sustainable market in general in many of these major capital cities is certainly there. It points towards, for me, a much more of a stable property market for the time being versus an unstable, oversupplied market anytime soon. And if you add in cheaper money at some stage, the government's got a challenge there, because all of a sudden now we've got potential for much higher growth again, and rents aren't going to go down anytime soon, unfortunately.
Yep, and that's the environment, and that's the market cycle that we're in right now. And it's how best you configure yourself and plan around it to determine how you're going to go about investing in property. So I think we're telegraphing that for the next iteration report. A lot of the interpretation and recommendations made by people is going to be probably population led.
Yep.
For what we're seeing this year, how much of that is being influenced through, population increases, do you think?
I think it's probably quite a stark combination of affordability coupled with population and supply. I think if you look at this data coupled with what's actually played out for 2023, one of the bigger emitting markets, which has been one of the probably the best performing markets over the last 30 years in general, has been Melbourne. Melbourne has not had a great 4 or 5 years in general. And the market data looks likely to say that's probably going to continue for at least the next 12, possibly 24 months, because they've got an issue more so that's been led by their response to COVID, and there's been a fair bit of issues with regards to both their economy, their supply, their infrastructure is a little bit different to probably most other markets, and they probably don't have the same appeal that they may have had 5 years, 8 years, 10 years ago. Sydney definitely bucked the trend for a lot of people unexpectedly, but it has remained very consistent and very resilient when it comes to the economy. The actual supply pipeline, the government's just put out their treasury data for the next year. It looks quite healthy. They're going to be running a very decent surplus again. So there's probably going to be money to continue to reinvest in this market. So if I'm looking at where it's going to be next year, Melbourne will likely not feature very heavily from my perspective and expectations of growth, but there's certainly going to be markets outside of Victoria and Melbourne which I think are going to continue a relatively close trajectory to what they did over the last 12 months. Yeah,
Melbourne's or Victoria's still got, I think it's going to be quite a long hangover from the COVID pandemic. Some of the decisions made there. Look, they've got a new premier, whether that's going to change things or whether or not that's just going to exacerbate issues again. No need to get political on this. We're viewing this through the lens of property investment, and just on that basis, with an eye towards the politics of it all, the yield approach for a lot of investors moving forward, and therefore how it may influence. Again, this is something you're probably going to see in next year's report, how it's going to influence capital growth. Is a lot of investors are a bit jittery around the influence of state governments in shaping property markets. By that, coming up with maybe they're knee-jerk, maybe they're well thought out, maybe they're somewhere in the middle. They're policy decisions to try and increase tax receipts on property, particularly property owned by property investors, and changing things, saying, okay, well, we're limiting the amount of Airbnb stock on the market. Oh, we're going to apply this new tax. Oh, we're going to do this. We've seen it last year and the year before, where they come out with these sometimes harebrained schemes to try and make a few more bucks on the on tax receipts, and they just can stifle property markets. I think you've seen some of that in Victoria, but I know a lot of property investors who are like going, I just don't know what they're going to do, and them being state governments or the federal government's pretty stable in how it's approaching stuff. You just don't know. You just don't know they're going to go. Oh, I heard some scheme of like charging, 400% more tax on land tax or something for property investing. You just sit there and just go, why would you invest in property?
Yeah, exactly.
You just don't know.
I mean, this is probably someone, for anyone who's listening and is thinking, I've been considering buying property for a long time or even a short time, and they're hearing this and they start going down this rabbit hole of Googling places to invest, where fits my budget, all these things, and all of a sudden they might go down a conspiracy theory, and what will hit your feed is essentially that, Phil, is you're right. As a long-term property investor such as yourself and I over the last decade plus, we've certainly seen plenty of times or eras where there's been a lot of turmoil and other times where there's been a little bit of stability. But I would probably suggest that turmoil is a lot more consistent than stability when it comes to state and federal policies and changes and things like that. So it becomes you become very desensitized to it, and you realize that most of the time common sense prevails, because the vast majority of these harebrained schemes are vote grab short-term aspects. And there's a couple that I can think of. Obviously, the Palaszczuk government's backflip on what they were proposing last year, that obviously was something that it did impact the market quite significantly for a very short period of time. The irony of that was that they were trying to tax private investors for buying property if they own property outside of Queensland, and then essentially try to disincentivise them to invest in properties in that market to provide rental accommodation in a market that is sub 1% vacancy rate, and thinking that would solve a problem when in turn it exacerbates a problem. I can think of the Greens who have had this policy at the moment, and again, not that I'm going to take an alliance or allegiance to one side or another, but policy in particular. Greens have been talking about rent freezes for a very long period of time. Now, if anyone who's listening to this owns an investment property, they would likely know that over the last 2 years, they've seen the best part of more than 4% increase into the cost of holding the interest rate on their investment or investments. Now, if someone's going to tell you that, hey, the cost of $1 million debt has gone up essentially $40,000 a year to hold the equivalent property you owned 2 years ago, but yet you're not allowed to raise the rents for those people who actually accommodate your properties, you have to bear all that cost. What's the thing you're going to do if that's forced on you? You're going to sell the property if you don't have the buffers in place. And most people aren't going to have those types of buffers to then say, well, I can't pass on those increases. So ultimately, I guess I just have to hope that it goes up in value and also earn enough money to have a surplus to hold this. Most people aren't in that position. So what happens? They sell that property. So what happens to that property? Typically not going to sell to another investor because they're not incentivized to buy that property as an investment for themselves. So it goes to the private pool. Now, the intention is that maybe that brings down the price of the private pool over the long term to actually sell to an owner-occupier. However, when you've got high interest rates and you've got serviceability now dropping down and down and down, ultimately you have less people to buy the home to live in. The short-sightedness of these policies is, I think personally, I don't think it's not understood. I just think ultimately what it comes down to is that they may be appealing to people who don't scratch the surface of these policies and think this is actually really bad policy. This makes rents more expensive. It doesn't make property cheaper. But ultimately what it's trying to do is appeal to those students and anyone who's thinking this will bring rents down. Ultimately, it's all those nasty, naughty property investors who are ruining this whole country.
Yeah, and you've seen a flurry recently of all these articles where the suburbs where it's cheaper to buy than rent.
Yep.
Right. And you go, oh, that's okay, that's great. Well, why don't you buy a property?
Yeah.
I can't raise a deposit. Okay, so where are you going to live? In rental accommodation. Okay, so who provides rental accommodation in Australia? It's the mum and dad investor. Even that's been hijacked now where people are coming out going, it's not mum and dad investors who are owning property. They're all wealthy people who are owning property.
Yeah, right.
If you own investment property, you're wealthy, allegedly.
Yeah.
So it just goes around and around and around and around and around and around in circles.
We've heard it.
And back to the point, though, you don't know what's legislation they're going to bring out which may impact the cost of the hold and potentially the capital value of your investments. Like there is already rules around how often you can increase rents in most states of Australia. No. You can only increase your rent once a year. You go, well, why is milk going up every day?
Yeah.
Why is bread going up every day?
Why is my
petrol
interest rates
going
up every month?
Why is interest rates going? Yeah, that's okay. That's market forces, but no, it can't be property. Only once a year.
Yeah.
You go, okay, I can only raise it once a year, right? Okay, well, how about I raise it 100%? Oh, you can't do that either. You're right.
Correct.
Correct. They're trying to put. I'm being a bit glib there.
Yeah, you are.
But they're trying to put caps on how much you increase it because it's unfair. Well. Anyway, message to state governments. Come and have a chat to a state government. More than happy to.
I'd love it. I'd absolutely love it. And
they don't like coming out of the shadows, though. They don't want to chat. They don't want to chat to people like me.
Well, no, because ultimately they know that if you're coming onto a podcast network that appeals to hundreds of thousands of property investors who are doing the job of what most governments should be doing, which is 97% of all property in this country that's rental accommodations provided by mum and dad property investors, where it used to be circa 75%, but ultimately over the long term, they don't want to invest in it because they know they can't get returns to then essentially be able to get re-elected. Here we are.
Government doesn't want to hold too much property because they make too much money off property, particularly state governments.
Exactly. So they're making the tax receipts, stamp duty, land tax, which they've also, we admitted land tax and the increases of land values over the last couple of years. Anyway, you and I, mate, we could be sitting down out the front of a coffee shop and just chinwagging about this like a couple of pensioners who have had their time in the sun.
Well, I think I might have been mentioning you, maybe it was someone else. I know people in the government listen to this podcast because a lot of the things I talk about and how I view things sometimes end up in other people's language, right? It's surprising. I read some things sometimes and go, where did you get that idea from? Because I'm pretty sure I was the first idiot to sort of think of that. But anyway, call out to all the state governments. Come and have a yarn. It's a nice, safe place here. We
absolutely,
as property investors, we are considerate and very respectful of the important work that the governments do, and we acknowledge the important work that we do in providing tax receipts for ensuring state governments continue to spend the money they need to spend on other services, social services. For example, I'm a big fan of a lot of the work provided by our governments at all levels around supporting certain segments of the Australian population that need support. It's great. That's why we want to live here. But, Paul, let's just get into – it's getting into a bit. But you've chosen one particular state here as part of this year's report, and let's see how you go next year. But it's a bit of a trend, and everyone can – probably tell I'm talking about Western Australia here. So let's talk about the performance of some of these suburbs which made the report and see how they're going. We'll just go to another break. Stay with us, everyone. Back in a moment. Welcome back, Phil Tarrant from Smart Property Investment. And to our friends in the government, if you want to go a yarn to us, editor at smartpropertyinvestment.com.au, come and have a chat. Let us know what you're doing and maybe some of the realities of running the balance sheets of the state or the states and how you go about some of the decision making and where property investors fit within it. We'd enjoy those conversations. But Paul, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13 suburbs of I think about 20 that you provided originally made it into the list of the Fast 50 and Western Australia in many ways, and you come up with it beforehand. I think there was more Western Australia properties than anywhere else. Then it was Queensland, then it was South Australia. There was a couple in New South Wales, by memory.
Very small amount, one in Tassie, a couple in Melbourne.
Sorry, a couple in Melbourne. There's a few more in New South Wales. So let's just start at the top and you can tell us what's going on. Armidale, Western Australia. So don't be confused. From what I understand also, my people tell me you've actually bought a couple of properties in these locations based on the report as well, putting your money where your mouth is. So when we get to the suburb where you've done that, let us know. But tell us about Armidale.
Well, let's start with that
6112.
Well, I actually personally bought property in Armidale this year. So in my super fund, there's actually a theme. I think we've ended up picking up 3 separate properties in our super fund, my wife and I, this year. And essentially it was really to do exactly this, mate. We intended to buy property in our super fund resi space this year. And I thought, well, what better way to test the waters than to put my money behind my research? And Armidale was one of those markets which we bought. Now, Armidale itself has grown by circa, where are we at here, by 16.4% based on the data that we have. So that's capital growth. That excludes rental yield. Rental yield in that market, depending on what you're buying, is probably circa 5, 6, 7% straight off the bat. But that's a market that effectively was anyone who's on the East Coast. It's probably your entry level owner occupier market, but still has a circa it's about 63% owner occupied centric, vacancy rate sub 0.5%, with zero supply if you're looking at where and what's going to come to that market from new supply as far as greenfields, new builds, etc. So it's a built out market. It's also around about 35 minutes from the Perth CBD, around 15 minutes from the airport, a little bit south of that location. And it's also sort of on the footholds of the Canning Dam and up in essentially the Hills district there that goes up a little bit further towards the north of that market. But entry-level price points at that time when we were buying, and we, I guess, hint for anyone, a lot of our clients, we position them in these markets. Not necessarily to say that it was just because of the affordability, but if someone did have a constrained budget early 2023 of sub 400, sub 450, you probably can't pick anything up in Armidale in that price bracket anymore, unfortunately. But this was a great market to figure out where to buy. Decent blocks of land, flat, did have upside for zoning, very good entry level, sub, as I was saying, 0.5%. From a vacancy rate perspective. So really good rental growth, strong capital growth as obviously this year's played out. I expect that'll probably continue for next year and the year after as well. But you're still buying circa sub $500,000 in that market. And it's probably very early stages, I think, of a good 5-year growth cycle.
Well, I just did 16.4% of $400,000 to 65 grand. It's in your super fund, so you can't do anything with it.
Well, I can sell it and
you could do
pocket portion of it.
Do something else with it.
Exactly.
Yeah, it's not bad going.
No, well, if you leverage, and I guess going back to if you bought and I think from memory, my Armidale property as an example, bought for a touch over 400K when we did buy it, and I think I put 20% deposit, 5% closing costs. So it was around about 115 odd thousand, I think, tipped into that. If it's made gross 65K, and I'm selling that property for 460, 470 in that same 12 months or 12 months after. You know, that's is a tidy little sort of 40-odd% cash on cash return if you're looking at it theoretically.
Yeah. Obviously, investing in your super fund's a bit different outside of it, and we speak a lot about it on the Smart Money Investment Show. You go tune in. Tell me about Bertram.
Yeah, so
Bertram. Is it Bertram?
Bertram.
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 Okay,
Probably, yeah,
6167.
Depending on who you do want to take your vernacular from. But if you talk to a Perth resident, it'll be Bertram every day of the week to them. But again, Bertram, a market that's predicted. Again, it was probably slightly higher price point, probably more like a middle ring market for Perth / middle outer ring. Performed a touch over 14%. As far as where the capital growth came, I would suggest for anyone who's on the East Coast, you're probably positioning it as a bit more of probably a market that's slightly coastal. It's a little bit further down south, and it's also essentially on the highway corridor, train line corridor. You're about 10 minutes from the beach, so you've got a little bit of lifestyle. You've got better proximity to the CBD. But again, an established market within an established area. It's got all the adjacents, but again, undersupplied and within a good lifestyle and essentially good affordability corridor. So all those boxes ticked. 0.2% vacancy rate at the time we were buying it. So when anyone is looking at markets from a vacancy rate rental standpoint and the fear of properties sitting there vacant for a long period of time, 0.2% is effectively there is no vacancy. So when you look at that and look at the fear of how does that market change dramatically, well, there's got to be a lot of supply and obviously a big reduction in demand to happen before any of that would change, and that's a long, long way from happening. So again, that will play out. So
is all this growth coming from the fact that nothing's happened there really for over a decade? It's like because you're buying at prices that you could buy sort of early 2000s.
You're effectively, a lot of these markets and almost all these markets are probably the price points, even now after circa 10, 15, 20% growth in the last 12 months, you're still buying property where it was trading for at its previous peak around, well, maybe in some cases 10, 15% above its previous peak of 2012, 2013. If we look at what's driven it, and a lot of I guess the naysayers might think, oh, well, hang on, Perth's been on the it's been on the lips of a lot of property investors for the last 12 months. This must be really investor driven and all this demand must be investor demand. The reality, if you look at mortgage data and actual mortgage origination data as far as the purpose of these properties, it's well over 75% of all properties that are transacting in Perth at the moment are selling to owner-occupiers. So if you look at that versus the long-term averages, it's pretty much bang on the long-term averages of investors versus owner-occupiers. So ultimately, the demand is driven by owner-occupiers, and the problem, and also I guess it's a good thing if you are a property investor, is as rents increase and the pressure of markets at a 0.2% vacancy rates, you've got a low unemployment in that market, sub 4% still. You've got equivalent average household income of Sydney-siders, only second to Canberra. So you've got people who are employed, you've got people who earn a good average income. It's the lowest average mortgage or actual sale price as a capital city of any market other than Northern Territory. So you've got people who earn more than any other city in Australia except for Darwin. And then all of a sudden you've got the lowest amount of vacancy. So people are going to say, well, either I rent, my rents, if you look at those averages that you're talking about earlier in this podcast, Phil, about people who are paying more for rent than they would for a mortgage, you go into Perth, and there is a lot more suburbs, So all of a sudden people are on a good income. It doesn't take all that long to put together an 80, 90, 100 grand deposit if you're a first home buyer or someone who's on 100, 150, 200 grand household income combined. So they can get the mortgage, they can get the deposit, and they're starting to do their math to think it's actually cheaper to buy a home than it is to continue to pay this rent. But you can kind of see from the vacancy rates that this isn't a trend that all of a sudden changes overnight. So you're still very owner-occupied driven as far as where this demand comes from. And the new supply is a problem. So there's not much of it coming, and there hasn't been much of it over the last 5, 6, 7, 8 years.
So on this podcast, you always talk about this discussion around where to put your money today for the best capital growth in 12 months' time. So this is our 2023 report for 2024. So most people who talk about property investment talk about all the good stuff about property investment, right?
Yep.
So let's just turn that on its head. For a decade or more, if you invested in Perth a decade ago, you might still be behind the 8 ball when it comes to the value of that property today versus what it was when you paid for it. So there's a whole bunch of people who haven't done well in property investment. And this is the point. You always hear all the good stories, but this is pretty much a cadre of people for over a decade who've put money into the Perth market and paid mortgages on it, and the property's gone nowhere. So it's all about picking the spot for the right place at the right time.
And this is the hard part, is that we talk about it's time in the market versus timing the market. For those who make good money in property in a decade period, you've got to do both. You've got to hold, but you've also got, you can't buy at a point in time for those who bought, for instance, lifestyle properties at the end of last year. So I can think of a few key markets that are very expensive coastal suburbs right up and down the East Coast and right over, WA is not devoid of these types of markets as well. People thought that this whole boom market of very high-end lifestyle properties that were going to be low interest rate environments, they're the markets doing worse. It is essentially making sure that you, A, time it, but B, you can hold for a prolonged period of time. But if we look at WA as that example, you're right, Phil. Anyone who bought at the turn of this decade, or last decade rather, and look at that performance of that property versus a lot of other markets right now, they're going to say, look, it's really average. It's probably averaging 2 or 3% annualized for the last decade. But we've had this conversation years ago, Phil, about the same thing with Brisbane. I can sort of cast my mind back to 2017, 18, 19, where people bought pretty much same time, sort of 2011, 12, 13, 14. They would have bought then, and they would have reflected at 2018, 19 and said that market's done terribly. If you compared to buying in Sydney or Melbourne or Tasmania at that time, you would have done much, much more. But then fast forward 4 or 5 years, and you look at it, you're saying that same property now has well and truly doubled in value. The hold is obviously what allows, but if you timed it better and you bought that same property in Brisbane, as that example, in 2017, 18, 19, which was what turned out to be pretty much the bottom of that market, and you looked at it now, you're like, in that 6, 7, 8 year time frame, I've probably doubled my money, where I've could have done it over 15 years as well. Every market has those dynamics. Every market, when you look at it over a longer period of time, has good times to enter, good times to exit, times to avoid certain markets. And that's the genesis of this report in itself, is that these are markets that you're looking to buy into with the horizon. Say you're going to hold this relatively long term, but you're likely to get better short-term outcomes in these markets versus others. Yeah,
and that's a good point. This shouldn't be investing with 12 months in mind.
No.
You're getting the upside, right? That's great. But, it's about highlighting those suburbs which will have the propensity for immediate capital growth, but also have long-term potential. And this is something that a lot of our experts who contribute to this subscribe into. I wouldn't be encouraging people buying a place and selling it in a year's time, because, to your point around the place you bought in Armidale, you might have got $60,000, $70,000 of capital growth, but what did you pay for stamp duty on the way in. What would you pay for the agent on the way out? You know, you're going to erode into that paper profit pretty quickly. Let's chat about some of these other suburbs. You got Camillo here, which is 15.9%. That's pretty good. We won't go into too many details.
No.
Based on the postcard, is right next to Armidale.
Yeah, correct. And you can group Camillo, you can group Forestfield, another market I've personally bought in this year. You can group Gosnells into that same market where they're sort of all centred around that's the airport precinct, airport district. They were affordable corridors. Again, markets that we knew owner-occupiers could afford. It was a good, strong tenancy market. There was absolutely very, very devoid of supply coming to those markets. Industry is strong. And also there's a fair bit of ongoing continued demand and also upside for potential rezoning. So within the Kalamunda Council itself, there's a lot more demand now to see, hey, how do we create more supply without creating new civils and releasing huge amounts of new land. It's looking at how do we change these 700 square metre zoning laws to allowing 2 or even potentially 3, which will allow supply over the long term, but also means your value of land ideally also increases if you're buying those correct assets.
Yeah, and Forestfield performed the best out of all these, or year to date annual growth from when you logged these numbers, 19.4%, Gosnells 10.3%. I must admit though, looking at all of these suburbs here, I reckon if you gave me a blank map of Perth and told me to tell you where they were, I couldn't tell you.
No, of course not.
I couldn't tell you. But if you asked me the same in Sydney, I'd probably get within a square kilometre
for sure
of everywhere. Brizzy, I'd be okay. Melbourne, I'd be okay. Adelaide, probably not that good.
Yep.
You know, so a lot of these names are just foreign to me. They're just
completely. And I think for anyone who's thinking about those markets, and I'll probably, for the sake of not going through these individually, if I look at Forestfield, Gosnells, Maddington, if I look at places like Aurelia, and also potentially Wellard, all those markets are relatively tight-knit as far as where they're located and what they provide as far as general. Some of them are more entry-level, some of them are more middle ring, some of them are more aspirational, some of them better school catchments, but they're ultimately all those areas which provide good. If I relate it to, it's sort of a meat and 3 veg type of market and an expectation that you know what you're going to get. Based on the data we saw, we're going to see what we expect, and I think next year will play out relatively similar. They also well and truly into the double digits from a growth standpoint.
Yeah.
I guess if I then zone that away from what other market we were sort of recommending, which we thought would outperform the general national averages over that 12-month period of time, and I do believe over the next few years as well, more south of Perth, where you're getting a commuting corridor to Perth if you did still work out of that, but you wanted more access to the coastline and some more access to the lifestyle. You still got train lines, still got highway straight to the Perth CBD, was down towards Rockingham and Mandurah. So those two markets themselves, Rockingham, Mandurah, Port Kennedy, Greenfields. There's probably 4 specific markets there, all of them at different ranges south of the Perth CBD itself, but all of which have well and truly outperformed those averages. And I can speak of Mandurah as a market in particular. I personally bought property in Mandurah this year as well. Again, a 1,200 square metre block, rezoned what is deemed to be R100, which is the equivalent of unit block development upside. But again, it was a sub $400,000 purchase, renting for circa $520 per week, corner block, plenty of upside, really simple to just plonk into the portfolio and do very little with. A feature across all these properties, and I think it's a feature going down the pathway of where higher interest rates also allow for people to start to think, well, my affordability and my ability to borrow money is being eroded every time there's an interest rate increase. We certainly had an intentional ability to say, well, we're not going to recommend markets which are $900,000, $1 million, $1.5 million. And that doesn't mean not necessarily just in the Perth market, because there's certainly plenty of suburbs which feature in those types of price points. But when we're looking across the board, we need to find opportunities which the average mum and dad investor who's potentially looking to buy their first investment or already has a principal place residence and a little bit of equity and wants to start to build their portfolio, we have to be realistic to figure out which markets we can still deliver capital growth, which are going to fit a budget, which are also going to have yields which are going to be enough to hold those properties, not just short term in these higher interest rate environments, but over the long term when you come through things like repairs, maintenance, ongoing costs that come with re-tenanting properties. So the consideration of these markets is not just which is going to grow most in value, which was certainly achieved, but second to that, it's what's going to fit the average person's budget, because it's all good and well finding markets which are going to give us double-digit growth. But if they're $1 million, $2 million and beyond, they're out of reach for the vast majority of investors. So what you'll notice and what's featured a lot in those 13 recommendations that we had, I think the highest price point was maybe a touch above $600,000. The lowest price point in those markets that we recommended was a touch above $300,000. They were all freestanding established houses. And you'll notice that when we put out our list for next year, it's going to be very similar. Now, those $300,000 or $400,000 markets are probably gone by now. It's going to be more like probably $450,000 to $500,000. And maybe they're between there and $650,000, $700,000. But for those out there who are listening and thinking, I want to start or I want to continue to build my portfolio, there are certainly plenty of suburbs that are going to see good, consistent, strong, above average capital growth, as well as 5, 6, 7% yields. If you're happy to maybe only need to part ways with about $500,000, maybe $550,000, versus necessarily fully going all in on a market of north of $800,000, $900,000 and beyond.
Yeah, it's a good point. A lot of people go, well, why would you need to do the list again if it's going to be all the same properties? I'd say that's exactly why you do the list again, the same suburbs. It's because it gives you a sense that property markets, it's about identifying them earlier on and riding it through a period of time and then exiting it when it's time to exit it. That normally doesn't happen within a year.
No. Extremely rare, if ever, is it going to be a 12-month time frame where you bought and you're going to sell for the right reasons. If you're selling, you're probably selling for the wrong reasons, but you might see times where you get 20% capital growth, but that's still, for me, not enough to really justify parting ways with the property either, for that matter, because to your point, and we go through this a lot in this podcast, Phil, is that there's usually somewhere between 7, 8, 9% transaction costs in property. So ultimately, your break-even point we find in residential property, excluding how much it costs you annually to hold a property, is about 10% for it to even really start to give you a return that's going to justify what you've put into it versus what you got out of it, excluding any capital gains tax as well, for that matter. So again, it goes back to the point is that we want to see, yes, 15, 20% capital growth in a year is fantastic. It gives you the ability to really expedite the next property potentially or something else further down the track. But it's certainly not justification to say time to sell that property and take the profit and run.
All right, well, I look forward to your recommendations, Paul, which I know you and your team are working on right now, and we hope to unveil that in a month or two's time for that'll be for 2025. But based on the performance, a lot of these suburbs you recommended for this year's report, I'd like to think that you guys hopefully would want to emulate those successes.
Absolutely. I'll take them every day of the week. And I guess a hot tip for anyone who's listening to this and thinking, well, does that mean when this report comes out, you start buying them? Well, I can attest to the fact that a lot of these
should have been here yesterday.
Well, we're buying in a lot of those markets now. So this report's likely to come out early 2024. I can pretty much assure everyone that those markets that we're going to be recommending, we're probably buying in those markets as we speak. So if you do want to get in touch, you can get in touch with us to start talking about that before this list potentially is released. Little pre-list list for anyone who's interested.
Pre-list list. Get the list. Get the hot leads, the hot deals. The places you need to be. Well, you can. Where do you go if people want to chat to you?
Purepropertyinvestment.com.
Yep.
They can set up a time to chat with us. Our books are going to be pretty close to full for this year. If they get in soon, they might be able to book in some time to chat with us soon. But early January, they'll be able to get some time to chat with us and figure out where and what markets are going to be featured both in our list for next year that's going to be launched via SPI, but also where we're going to be recommending people invest, again, as little as $450,000, $500,000 budgets.
All right, well, you've got the opportunity there and the invitation to get the inside run on this. So you don't need to wait until the list comes out to make decisions. So my recommendation would be if you can invest in property today, invest in property today. Don't wait for this list to come out. But for a lot of people, it's probably going to help them on their way. That's Paul Glossop from Pure Property Investment. Thanks for your time. Remember to go and listen to us. We did 5 or 6 podcasts around the report. We pretty much covered off every single location, gave our sense and sentiment to it all. They also wrote about it all over smartpropertyinvestment.com.au. Go and check it out and enjoy. Thanks for tuning in. We'll see you again next time. Until then, bye-bye.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.